Hello and welcome to the Trading Zone. I'm Joe Teague of Equity Armor Investments.
Hi, how you folks doing? I'm Brian Stutland, portfolio manager at Equity Armor Investments. We have a great show here on the Trading Zone, sponsored by the MIAX today. Obviously, some news out, some volatility happening, VIX spiking. So lots to discuss, right, Joe?
Yeah, Monday after the weekend, vols up, the market's down, vols up, but vols up a little bit more than all that. So just a lot of uncertainty out there. Some things we're going to touch on our show, but just a little bit of angst broadly by the market is what I feel.
Yeah, and really, I don't know, some underpinning things that we'll get into, but obviously Middle East tensions continue to run wild a little bit, make people nervous. So you as investors, you start tuning in here to our shows. We go live. We love to give live market commentary updates along with talking about volatility, where that is moving. And we also have a trade of the week for you at the end of the show.
Yeah, stick around to the end. You don't want to miss that. As usual, always check out our website, equityarmorinvestments.com. Reach out to us, comment live, like and share the video if you're not live. On our website, you can look and find our book, Trading with Edge. Some great insights about how to trade. And yeah, just follow along with us for everything else.
All right. So, Joe, what do we got on tap here today for the show?
Let's do it. Let me share the screen and let's light it off. So again, welcome to the Trading Zone, the show by two former VIX market makers talking about portfolio management and volatility like we do every week. We had big jobs data coming through, and it was so good. On Monday, we were saying it was the last chance for before the election for this jobs data to be manipulated or pushed a certain way. But it was so good. People are rethinking the rate cuts. Maybe not another 50 basis point cut coming, but certainly more rate cuts are coming. There is going to be some big inflation data this week. I think if good inflation data will mean that rate cuts will still be coming, if not as big as previously thought. But we're going to get into, in a big way, oil shocks and the price of oil on this show. Today is October 7th, a year on since the start of this war going on in Israel. There's still rockets coming into Israel a year on. Just the reason why Israel is expanding the war on so many fronts to try to stop that. And there are more ramping up going on still in Gaza. Israel's in Gaza and Lebanon, fighting in Yemen, and also the most troublesome one for the market right now is Iran. So we have oil premiums being priced in now, but we're going to take a look at some charts. It certainly could go a lot further, to say the least, and take a look at those instances and what happened with the market when all that happened.
Yeah, and I think when you look at some of the previous times, I mean, we talked about this last week on our show, saying that we'd get really into what oil does, how that affects the market. So we're going to kind of get into there. I think there's some interesting statistics around it, and then maybe some ways to sort of trade and play around that and protect portfolios should something like this happen. But I think interestingly enough is I've been reading online on some intelligence reports that U.S. Central Command had just left Israel this weekend to head back and then deal with the ramifications of Hurricane Helene. So it's interesting that they were there and talking with Israel. I think the reason for the VIX being higher, maybe, in my opinion, is maybe there's some discussion going on whether Iran oil fields get hit at this point for what they did and what they carried out, which is considered one of the biggest ballistic missile attacks in the history of the world. So certainly it seems like there's a price to be paid for that. And we'll see how this all expands and how that plays out.
Yeah. So before we get into that, let's just really quickly go over what we got on tap this week. Big inflation data, like I said, more Fed speak coming out. We got the Fed meeting minutes coming out. Is there going to be more major October surprises coming out of Israel? We'll see. In the volatility world, something we look at every week is the SKU index, the price difference between the 25 delta put and the 25 delta call, and 1 month out in the S&P 500. And we are seeing very elevated levels for skew, not surprisingly, given that volatility is on the rise. So people are paying up today, and they have been for some time for these puts, Brian.
Well, it's interesting that people are paying up, in fact, for these puts, given the fact that the market is sitting at all-time highs or very close to it, which is really an unusual situation. Normally, we see sort of it's more panic put buying for insurance, people buying protection as the market starts to turn over and start to sell off. And it seems like recently, in the last, call it 10 trading days or so, people are trying to get ahead of whatever they may think is coming down the pipeline, whether it's the CPI inflation data coming up, whether it's Middle East tensions, whether it's the election at the beginning of November, where we will see an election, a Federal Reserve meeting, and unemployment rate all come out in the same week.
Yeah, and bottom line is we're talking about uncertainty. There are a lot of areas of uncertainty for the market. So that's why volatility is higher. People just don't know the future. They want some protection in case things go against them. Another way to look at this is the VIX futures term structure. Just looking at the this red line is where we are currently. That's the VIX. This is the front month future. This is the second month future, and this is the third month future. So, 2 months ago, August, we had the Yen-mageddon. Volatility was a lot higher then, but this is really now we're all over the map here. Volatility has been up and down and all around. Trying to find this range here. Of course, we still have this election coming. This October future consists of the November S&P 500 options, which is pricing in that election. I think we're gonna see some volatility over the next month or so, but this is gonna be something to watch.
Well, it's interesting because when you even look at comparing the VIX futures curve to a week ago, how much elevated the futures market and the VIX itself are versus that. So that's interesting. That probably plays in line with the fact that traders are buying put downside protection, despite the market's trading at all-time highs, like I said. So some concern that we're going to get some sort of shock and some sort of shakeout to the downside in the stock market, I think.
Which makes a lot of sense here, Brian. We're coming up. This is my favorite trend line. Like I refuse to give up on. We're coming up here. We're on the higher end of this range. We made all-time highs here. We didn't get into this upper channel here. Found some resistance here, so it makes some sense. This is an area of concern for me. Are we going to go down and test, maybe this trend line here, or just a little bit of a pull off? Just kind of makes sense at this upper levels.
Yeah, and this is why I think, looking at some of the data on oil shocks too that we have coming ahead, will start to make some sense on trying to find a strike price to add protection. Maybe not chase all the put buyers that we see in this front month option contract area and downside put, but maybe something a little different that can help add some protection to a portfolio should we get that pullback down into that red channel area.
Okay, so let's get into the oil shocks and how this affects portfolios and how it affects the market. I don't think this will be a big surprise, Brian, to learn that, when oil goes higher, it negatively impacts the economy. And of course, that negatively impacts the stock market. So I have a couple of situations here, a couple of scenarios I want to share with everybody just to kind of remember what happened historically and how it's going to either be like now or not be like now. It's not going to be exactly the same, but it's useful to look at what happened historically. So this is an interesting one. Of course, this is the 1973 Yom Kippur War. After the Yom Kippur War, of course, the OPEC nations had an embargo against the United States for their support of Israel. And we saw a big increase, of course, in the price of oil. It almost seems like before this event, oil was just stable at like $2 forever. But as you can see, it went for like 2.5 all the way up to 11.25 in a very short period of time. Not surprisingly, we saw a big sell-off in the stock market. This was at about, for a high of about 120 all the way down to about 60 in the S&P 500.
Yeah, so just so people recognize here, the black line represents oil prices, which moved about 500%, maybe a little more, in a very short amount of time back then. And the stock market did not like that for the next 6 months to follow. So that was definitely very disruptive for people willing to just invest in stocks.
Yeah, and of course, it was
the
very,
oil.
very disastrous for the economy. Another interesting parallel: 1979 Iranian Revolution. Iran oil came off the market, reduced the supply by 4%, and saw a huge jump in oil. In this case, we went from around $15 a barrel to around $35 a barrel. Interesting. We saw some ups and downs in the markets, but no question, this was a period of extreme volatility in the stock market.
Yeah, in this case, which is kind of interesting, maybe just because Reaganomics were taking over by the late 1980 area after he had won the election, that we were going to get tax and stimulus here in the United States. So the S&P probably had like turned the page and was looking to that stimulus package that was going to come due to the upside. But certainly, as the shock happened initially, there was a carpet shakeout. If you look in the red area, the S&P 500, marked by the S&P 500, from that June of 79, let's call it, to March of 80, a lot of back and forth with some pretty heavy sell-offs in there. So that definitely had a shock, but this was definitely one of the lower shock kind of situations out of, some that we'll show right now.
But there was plenty of volatility here. We had, a 10% sell-off here, 20% sell-off here. Yeah. So there was a lot of movement, even again here. So this was a period, economic struggle, uncertainty, volatility, and let's keep it moving because, people kind of forget these caused recessions, and these caused some volatility. So first Gulf War, Iraq invades Kuwait. We saw reduction in the supply of oil, and we got a huge spike in oil. We got oil went from under 20, it was about 15 all the way up to about 40 in a matter and basically a quarter. So absolute oil shock, and not surprisingly, we had a recession and a stock market crash or a dip to say the least.
Yeah, I mean, look at there, basically that's like a 3-month window right there, right, with a pretty significant sell-off in stocks during that time.
Yeah, so again, each 3 instances we're seeing volatility on the rise. We're seeing, we're seeing a lot of uncertainty in the market. Big sell-off here in 1990. Now, this one kind of, I had to throw it in there, even though it doesn't really fit the mold. This was not a supply shock, but it was an oil shock. We had the Great Recession. It was, people, the recession kind of hit, and people needed less oil. But leading into the recession, there was a massive shock in oil. Oil went from about $60 a barrel to $140 in a year. So that was an absolute shocker, which was really puzzling, because of course economic activity was slowing down, but there was so much tied up in the banking system. Maybe people didn't want their money in banks, didn't want their monies in money markets or cash. They'd rather just put it in some other asset. Gold would have been an option, but maybe looking at oil futures or oil just to say, hey, I'll park it here because I know it's still going to be there, rather than in a bank where I'm not sure it'll be there.
Yeah, I think the other ones were supply shock issues. This one was probably more of a demand issue. But either way, the result was very similar. We saw oil go up basically 100%, right? And then the market began selling off accordingly over the next 3 to 6 months after that. Not as terrible as at the full recession period at the end of 08. But remember, this sell-off in the market began at the beginning of 08, really. Bear Stearns collapsed in March. Oil kept going higher, and then that further weakened the economy and the stock market.
But there's no question this made the recession worse. This spike in oil, and part of it was actually oil tankers just sitting out at sea because the ports were clogged up because there were goods that people couldn't pay for. So the shipping lanes were just all bogged down because the global economy was just kind of shutting down because the money was just evaporating in the banks. So yeah, it's something interesting to look at. Doesn't necessarily parallel what we have now. It's maybe for a different show. But here's one that looks a lot more similar to what we might be seeing at now. The prices are pretty similar. We're at a similar level in oil. as to now. And this was the start of the Ukraine war. So, another oil shock, oil not coming out of Russia, of course, caused, a temporary rise in the price of oil. And this, we saw, the stock market really struggle over that period. We had maybe the transitory inflation turn into a lot harder inflation, whatever you want to call it. But the inflation looked a lot worse for everybody here, and wow, it's kind of caught people off guard, maybe seeing the market decline so much.
Yeah, and I think that you bring up the word, it looks maybe kind of similar. It really does in a lot of ways, right? Because in this one you had oil trading around $70. Right now it's in the 70s as well. It went up not 100 or 200 or more percent like it did in all those other previous eras. I think now the US, being such a major oil producer themselves, has sort of limited some of these volatility shocks to some degree. But the price of oil went from 70 to above 110. That 40% move or whatever was enough to sort of shake the market out, down almost 20% basically there in a 3-month window. So, and then we saw volatility spike as well in that first quarter of 2022. So once again, oil creating volatility, creating market sell-offs. And it's interesting, these correlations on how well they are tied together. So it's kind of an interesting scenario there. I mean, given all that though, Joe, what's something you're looking to do to protect against this? I mean, because this has been reoccurring. I mean, we just laid out, what was it? 1, 2, 3, 4, 5 different situations that could occur again. I personally have some concern that oil is going to see a spike and that, the war is going to slowly escalate or at least move into different areas of the war in the Middle East. And so, I mean, what would you do?
Yeah, I mean, I don't see it ending anytime soon. So there's definitely worries that a specific action could cause a supply shock. So you might look at these charts and just think it very plainly. This looks obvious as a portfolio management side, is just be diversified, but maybe in this case, increase my allocation to energy, increase my allocation to oil stocks and production stocks. Just make sure I'm diversified, but have a little extra juice on that end. And that sounds reasonable. That sounds right. But you, for me, really have to time it. Now, it seems like there could be a supply shock, but that doesn't necessarily have to be the case. Maybe the U.S. is gearing up for a supply shock. We're producing a little extra right now. What if there isn't any supply shock coming, and we're going to see the price of oil decline? Remember, going back to this chart, if you timed this 22, right at the start of the year, if you timed it perfectly and you got out right at the top, you did great. But if you didn't, you just held on to your oil allocations, well, you missed a lot of the tech gains here in 2023. So it really takes the perfect timing. And of course, you might be offside completely right now if there is no supply shock, but there is excess demand being produced. So that is the risk for me. I would go back to saying, hey, the three times, all these times we saw these oil shocks, we had a volatility increase too, Brian. And I will go back to there and kind of base my protection around that.
Yeah. So I think one thing I would do rather than chase maybe an allocation to oil. I mean, we do own ExxonMobil for clients as disclosure. So we have some, exposure to the energy sector.
Yeah, absolutely important to have your normal allocation to energy, but to have an extra to go like 25% right here or something on a portfolio, I think that'd be the wrong thing to do for me.
Yeah, because then you become chasing a momentum trader rather than actually just being a portfolio manager. And we like to portfolio manage. And so I think one thing I'd rather do is in all those charts, you've noticed a pattern where the S&P is sold off 10% or more in a very short amount of time, not so short that it's a month worth of time frame, but 3 to 6 months where there is a little bit of a pullback in the market. And so I would be looking at, let's call it a 6-month put option contract in the S&P, maybe. I mean, this could be the reason why there's some put buyers going on right now, but those are short-term put buyers. I would actually go further out, because this sell-off can last more than just a week or two. And when you get these oil shocks, and I'd be looking about 10% to the downside about 6 months out. I think that's something that we're actually going to be looking to do ourselves for clients before the end of today's trading day. So this is almost like a live trade idea here that I think is worth putting in play. And so personally, I think that gives enough of the protection where I can just kind of sleep at night. And if that sell-off is more than 10%, then I'm basically stopped out of the market because I have that put option contract that allows me to sell no matter how low the market goes.
Yeah, well, that makes a lot of sense to me. You guys got any thoughts? Make sure to let us know. I'd be curious to know what you think. Always can contact us if you have any questions about how we're doing what we're doing. That said,
so we do have one more trade, right? Let's get to NVIDIA.
Yeah.
We got to talk about that.
Do the trade of the week. Let's do it.
Yeah.
Let's do it. I gotta hit this on. All right. Here we go. Trade of the week. NVIDIA.
Yeah, so NVIDIA has their AI conference coming up here today, tomorrow. The stock's up 3% today. So I thought it probably makes sense to just throw this in, although it doesn't relate to the rest of the broad market macro picture necessarily. But all these semiconductor stocks here up sharply in the last, call it, couple weeks here, even last month. NVIDIA up about 25% in a month time frame. Other names like Broadcom, Taiwan Semiconductor, some of these other names that we own for clients through Equity Armor advisory business. Those kind of names have had a phenomenal 1 month move here, but none of them have really reached new all-time highs, whereas the stock market has. That concerns me. I want to lighten the load a little bit. I want to take NVIDIA stock. What I would do in my own personal portfolio would be take NVIDIA stock, and instead of continuing to own that, use options to sort of limit my risk. I'm looking at a call spread. This is November regular options. The November 135, 145 call spread I can pay about, this is actually a little typo there, 130 strike, 145 call. So I'm buying the 130 strike, selling the 145 strike for $6.40. It's about a $15 wide call spread that I'm paying less than half the value for to do this. So I get to continue to participate to the upside if we go. And this is before November earnings of November 21st. So we'll continue to update this trade. We'll probably even have a trade that plays earnings play, but just the momentum trade of this. Yeah, I mean, look at the chart there. Not hitting all-time highs yet, Joe. Do you agree that you want to de-risk a little bit? Is there anything else you would do with this call spread as well?
Yeah, so this is a common theme of a lot of things that we do, Brian. A lot of trades we look at. Stock replacement, we have less risk on than owning NVIDIA, of course, right here. Sometimes we sell a put on top of this trade to further reduce the cost of getting long here. One of the things Brian is looking to do is to take advantage of gains, of course. But the second thing, of course, is we'll be risking less if NVIDIA does pull back. On that pullback, we've talked about it. This would be where we'd love to sell a put, collect some of that money back from the call spread that we bought, just be at an area that we'd be love to get long at. So I think don't have a ton of conviction here at the higher end of the range where we'd want to sell the put now today. It is kind of close call for me. I might be looking at a put where we could do that, but we're kind of here at this higher end of this range. We obviously wouldn't put this on if we didn't think NVIDIA can break through here and get up to this all-time high area around the 140 area. But what we love to do is sell that put, make this trade free or make positive a credit. Again, I think if we were below 120, that would be something we do for sure. So if we pull back here, we sell that put in an area, we'd love to buy it, obviously. And if not, if we go higher, then hey, we have this call spread on. We're making money anyways.
Yeah, that's right. So this is a risk reward kind of trade heading in for the next month with shaky times ahead for the general stock market, but also a stock that's had a tremendous run up already. And the call spread allows us to continue to participate up all the way through 145, although we lose it, the premium cost to the call spread would minimize our total return to the upside. But hopefully we can, if there is some sort of pullback, I'd be looking to sell a put at that $6.40 premium amount to offset the call spread. Now, guess what? Stock pulls out back. I'm out of the stock, so I don't have stock risk. I've collected some money by selling a downside put when the market pulls back, maybe to that 120 level like Joe talked about. And so really, I haven't risked anything until I get hit on that put all the way on the downside. So this is a major, difference maker in being able to control downside risk for us. So it seems like it makes a lot of sense to do this now.
Okay, and I know we want to get moving here. Everyone's got a busy day today. Get back to trading and everything you have to do. I think it's been great action out of the semis today. NVIDIA, of course, leading the way, given this little hiccup. So this is something we've been talking about for a while. We wanted to see the semiconductors kind of catch up to the broader market here. The broader market made an all-time high. The semiconductors did not. We need the semis to kind of at least be making higher highs here if we're going to be seeing this market continue this bull run. So it's good action today. Maybe if we can kind of follow through, maybe even next week after a calm week, hopefully, I think the market can go through to all-time highs with the semiconductors back leading the charge.
That's right. All right. Well, this has been a great show, folks. Make sure you tune in every Monday, 1 p.m. Eastern. We go live and we give our trade of the week. We give you updates on volatility, lots of good stuff, macro environment. I'm Brian Stutland, portfolio manager at Equity Armor Investments. I'm here with my colleague, Joe Teague. Make sure you tune in every week to the Trading Zone, sponsored by the MIAX. We'll see you next week.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.